Welcome to this contenders session on failed auctions. I would like to start off by reminding you of the legal trade disclaimer, so if you just can read through this, acknowledge and accept, and then you may continue with the rest of the video. So today we are going to be covering failed auctions, starting off with the utility, then moving on to the implementation, ending with the tips and tricks. So first of all, I'd like to cover the utility and, in my opinion, why these are so powerful trading setups. The failed auction has the ability to recognize a major sign of weakness or a major sign of strength. It provides a very high risk to reward ratio trade setup. And finally, the trade is offered with an easy entry trigger and invalidation. So the failed auction provides three major advantages when it comes to taking a trade. It gives you the entry trigger. You know when to take the trade after seeing the failed auction. It then provides you with a very high risk to reward ratio trade setup because it gives you a very close, well-defined stop loss invalidation, as well as a very well-defined target. Okay, so we have everything that we need. We have the ability to recognize a major sign of weakness or strength in the market. Upon seeing that, we have a very good entry trigger, the invalidation, and then a target, as I'm going to be explaining as we move on to the implementation of this failed auction. So what we're going to be looking for is primarily based in a range. Okay, I love to trade failed auctions within a range. It doesn't have to be, as you'll see throughout the course of this video, but I do love them within a range. And what we'll be looking for is sideways price action and price really simply breaking above the range high or a previous high of that range. Price then comes back down into the range. So you can see this is similar to a swing failure pattern. Very similar to a swing failure pattern, but it is a failed auction. There are differences, but they are similar. We execute the trade with stop loss above the high made. Okay, so similar to our swing failure pattern, we're in a sideways range. We're waiting for price to break above. That is not a failed auction yet. When it comes back down into the range, that's when we've got our failed auction. That's where we can take that trade. And that's where we've got now our invalidation above the high made and our targets, as I'll explain as we move on to the examples here. So as we can see here, we have a well-defined range high, range high, range high, range high. Price breaks above that range high, taking out the previous high or the highest high made within that range. We take out that high. At this moment in time, we have a legit breakout. We have a breakout. There's no failed auction yet. Okay, a swing failure pattern is just a case of going up and straight back down very quick. Difference here is on a failed auction, we spend more time above the high. It's not a simple up and straight back down. It's up, spend a little bit of time, gather liquidity, and then come back down. And it's when we come back down into the range that we have the failed auction. The preferred scenario on that initial move up would be of an increase of open interest and volume. Okay, e.g. lots of people trading the breakout. Why? Because if we come up here, we see a lot of volume and open interest increasing, and then we actually come back into the range, we're left with a lot of trap traders. Of course, this is a bearish example. A failed auction here would be a major sign of weakness because we've failed auctioned the highs. If you reverse this and we fail auction a major low and you come back into the range, well, that would be a major sign of strength. But in this example, it's a bearish short opportunity should we come back into the range and confirm the failed auction and the sign of weakness. So you can see here, price spends this is a 4-hour chart, and so you spend a good amount of hours above the high before eventually coming back down. That's the key difference between a swing failure pattern and a failed auction. Here we spend a good amount, a few hours above the high before coming back in and confirming the failed auction. Swing failure pattern is just like this, a wick up straight back down. It's a swing failure pattern. This is a failed auction when we spend a few good amount of time above that high. So as we can see here, price comes back down below the high. After seeing this, we can open a trade with a stop loss above the new high made. Of course, in the bearish setup, stop loss would be above this high. If it was a bullish, we'd be waiting for the failed auction and stop loss below the low. But as soon as we come back into that range, back below that previous high, that's when we have an executable trade. We have now confirmed the failed auction, stop loss above the high, and take profit one is context dependent, I'm not going to lie, but take profit one could be the last low made. What I mean here is the last low before that new high. We could use this last low before the new high as a take profit one. We could alternatively use tools such as the range pointer control, take a fixed range, use the range pointer control. We could use the CC, for example, low to high, look for the Fibonacci CC, the overall range low. Okay, so we've got a few different targets, and this is depending on the context, depending on, what amount of volume happened here, how bearish is this, was this a major level of resistance, was this an intraday level. These are going to be factors used to decide what we use as a take profit one, but we of course are going to want to look to take profit one. The standard one could be the last low made before the high or the CC. This is going to be a good take profit one target in general. Okay, in the end, you can see price makes its way down. You did in the end get a bit of a retest, as you can see, retesting this high here on this candle, not taking out that overall high though. And price moved its way down to take out the last low before that high was made. After hitting that take profit one, we have a few options. We can move that stop loss, which was above the high, down to our entry. We can move that stop loss down into major profits, or we can just not adjust the stop loss and keep the stop loss where it is. Take profit 2 is once again context dependent. Could be once again the range pointer control, CC, next major monthly level, etc. E.g. the take profit 2 would be another major level that we have within the chart. And this is now a example of a failed auction in a bullish scenario, as well as not within a range. So my preferred scenario is when it's a little bit range bound. It's easier to define the levels, but doesn't mean it's the only way we can take the trade. So here we have a key level as defined by a major SR level as well as liquidity. This is where we like to see. So we can see low number 1, low number 2, slightly higher low. So stop losses below this have now formed as well as stop losses below this. So we have a key level where we can look for the swing failure pattern or failed auction. Again, swing failure pattern is a quick down, close back above. The failed auction is we're spending a little bit more time below this low. So as we can see here, price makes its way down to that key level, e.g. taking some liquidity. And with taking that liquidity, price spends a few hours below the low. Again, this is a higher term time frame price chart. Price is spending a time below this low before going for that reclaim. During the time of spending price below this low, people believe the breakdown is real. And you're looking for, once again, an open increase in volume, increase in volume and open interest, where people are getting scared here, they're closing their longs, they're opening shorts, and, well, they're expecting the breakdown to occur, right? What we're waiting for is we're remaining patient. Upon taking the low and spending time, we're not taking a trade yet. We're waiting for the reclaim into the range above that previous low here to confirm a failed auction. And what we can do is we can also look at things such as ATUS, XO charts to look at the order flow. Here, from this example, while spending time below this low, we started to build bullish CVD divergences. So price is making higher lows as it forms this mini rounded bottom. And upon making these higher lows, the CVD is making lower lows. Okay, so this is bullish CVD. And you can also see open interest slightly increasing. Okay, down here at the lows, which is also beneficial. So the order flow is very advantageous to pay attention to. Price goes on to reclaim our key level that we had marked out. Upon seeing the reclaim is an executable trade. If we also have the bullish CVD, bit of open interest increase, this is even more advantageous to expect even more follow through on that trade. So upon seeing this, we could call this a major sign of strength. We've now got trapped shorts, bullish CVD at the very low, and a reclaim of our level to confirm the failed auction. So what we're doing here now, we would be, upon seeing the reclaim, we can enter a long trade. We now have our entry trigger, which is a confirmed failed auction. Our stop loss invalidation would be below the new low made of the failed auction. And the long, we can enter upon the reclaim, which gives us a target. Again, a few different targets we can use here. We could use CC, Fibonacci high here to this low, Fibonacci overall high to low. We could pull a fixed range from high to low. We could pull a fixed range from current low to new low to get the range pointer control. These are all different tools we could use, or we could trail our stop loss. There's a few different ways we could manage the trade once we're in it. But the most important thing is the failed auction is giving us a very clear entry trigger and invalidation. It's the take profit, which is context dependent. Okay, but generally speaking, we can use the CC from high to low to lock in that first take profit. And then from there, we can make a decision. Should we move our stop loss to entry? Should we move it up into profits? Or should we just keep it where it is? Because that's the overall hard invalidation. So upon entering the long, upon the reclaim, target could be the range point of control for take profit 1, and take profit 2 could be the overall range high. And then we're looking for this range to form before it's even formed, right? And here you can see how this plays out in the end. Price made its way up. Price made its way up again. It got a very low retest, and this is where you have to make a decision of where you're moving your stop loss. If you had moved your stop loss to entry, if you'd moved your stop loss into profits, you'd have been stopped out before hitting the overall target. If you kept it where it was, it would have been intact. All I would say in this example, is that if you have, for example, moved your stop loss into profits, moved your stop loss into profits, and you get stopped out here, well, then you could re-enter much lower. So there are times where it is advantageous to move up that stop into profits with the higher lows. Upon getting stopped out, you then can enter into a new long lower. For example, here you get a swing failure pattern of this low, right? So just to highlight one more time the difference, here you can see the failed auction where you spend several hours below the low before the reclaim. The swing failure pattern, quick wick down, close back above. That's a swing failure pattern wick. This is a failed auction where we're spending more time down here. So I'm going to end with some tips and tricks for you. Number 1, take profit should be context dependent. There's never going to be a time where we say this is always the take profit 1, because every trade is unique. Every trade comes under different context. So if every trade is unique, then we need to understand the take profit is always going to be different. Could be the VWAP today, could be the CC, could be the range point of control. We have different ways we can identify take profit 1, but every time it is going to be different. My preferred timeframes are the 30-minute chart and the 4-hour chart for failed auctions. Okay, the higher the time frame, the more follow through you should see. 4-hour chart is very good for your swing traders. I like to see the 30-minute chart because this comes along with my TPO charts. Every new letter is every 30 minutes. So I do like to trade this with a 30-minute view or a 4-hour view. Those are my preferred time frames. You could trade this setup on any time frame. Okay, from the 1 minute to the 1 day, but my preferred are these, the 30-minute and 4-hour time frames. And again, it is similar to a swing failure pattern, but slower to form and gives better follow through once confirmed. So this is, again, similar to the swing failure pattern. I'll just show this view once more. This would be a swing failure pattern of this low, for example. This is a failed auction. I prefer the failed auction because it gives more follow through. Okay, you have to imagine this is trapping a lot more traders than a quick wick. Okay, and that's why it gives more follow through. You're going to trap more traders, catch more people on the wrong side of the market, and the follow through is greater for that reason. When trading failed auctions, I prefer market entry orders after the failed auction has occurred. The reason for this is the move down is normally quick, so waiting for limit orders, there is a high risk of not getting filled. Okay, so once I've seen that failed auction, once we've got back into the range and I've confirmed the failed auction entry trigger and the invalidation stop loss, I'm going to just, bam, enter at market. I'm not going to place a limit order and try and get filled at limit because there's a high likelihood that price is going to move relatively quickly. And if I'm sat there waiting for a limit order, I'm going to miss the trade. I'm going to miss the entry. I'd prefer to, pay the price of doing business, get in, and secure that trade. And how do I get in and secure that? It's by entering a market. That way I'm not going to miss that trade. And I prefer to, take this market entry when I'm trading failed auctions. The same for swing failure patterns. But here I'm going to be using the market entry after confirming that failed auction. Okay, so I'm going to thank you all for watching this. We'll remind you all, a live stream covering the question and answers about failed auctions will be hosted on January the 4th, 2023. You can submit your questions for this live stream in Discord via the topic of hashtag lessons question and answers channel. And for additional question and answers, head over to the trading assistant in trading help on the Discord. Okay, so I hope that you can now maybe watch this a few times. So watch this session yourself 1, 2, 3 times over. Understand all the information, maybe go over to TradingView, test this out yourself, start to use failed auctions, recognize them, and then once you have some questions, post them over in the Discord, and I will answer all of your questions and give you the answers there in that live stream on the 4th of January. So thank you ever so much once again, and we'll catch you in the next session. Thank you and goodbye.